At 3:30 p.m. on May 10th, 1866, a messenger rushed through the doors of the venerable Bank of England carrying news that would freeze the blood of every banker in London. Overend Gurney Company, the firm that literally invented modern finance, the institution 3 times larger than its nearest competitor, the bank that other banks turned to when they needed help, was hours away from collapse. They needed £4 million by the close of business, or the entire global financial system would implode. The Bank of England's response changed things forever. They said no. Welcome back to the Timeless Investors Show. I'm Overend Gurney, real estate fund manager, student of history, and your host today. And today, we're diving into a financial crisis so devastating, so systemic, and yet so forgotten that I guarantee none of you have even heard of it. But here's the thing, what happened on Black Friday, 1866, is happening again today and will happen endlessly into the future, just with different names, fancier spreadsheets, AI, computer ecosystems, and everything that goes into it. Because when you understand how Overend Gurney fell, you will understand why other banks like Silicon Valley Bank fell, why Lehman fell, why every shadow bank that gets too clever eventually falls. The wheel turns ever onward, and we're about to see exactly how it turns. Now, I told you all, as guests of this show, listeners of this show, a while ago, that we were going to study various thematics in the course of the Timeless Investors Show. The heroes, the villains, epic stories from financial history, and the crises and the crashes. Now, I wanted to bring today this particular study to you guys because I think it's a fascinating story. It is so emblematic of human nature, behavioral finance, the pernicious effects of greed on the human psyche, and how people will reach for risk until they die. I had a mentor tell me one time, actually, he was on this show, Ron Dan's. He came on a while back, 53 years in the business, never had a blow up, never failed. We were talking about some very notable real estate figures today who are on the verge of bankruptcy or failure. Gentlemen who have massive portfolios and done very well. And he made a quote that I love. He said, "Some guys just can't stop themselves." That is true of human nature. And people sometimes say to me, why do you write about all this history stuff? Well, the reason I write about it and I love it is because history spans thousands of years. But you know what is the common factor across all of history? Humans. And humans never change. So without further ado, let's dive into this epic and tragic tale. So let me paint you a picture of Victorian London. It's the 1860s. Britain rules the waves, controls global trade, and London is the undisputed financial capital of the world. Somewhere in London, Ebenezer Scrooge is walking around, Shakespearean festivals. Think about it. That is what we're talking about. If New York is the financial capital today, London then was that times 10. And at the corner of Lombard Street, in a building so important, they just called it the Corner House, sat the firm of Overend Gurney and Company. It was started in 1805 by a Quaker named Thomas Richardson, but this was not a bank in the traditional sense. It was what we call a discount house. They would buy bills of exchange at a discount and hold them to maturity. Think of it like this. If you're a merchant in India selling tea to London, you draw a bill on your London buyer, but you need the money now, not in 3 months when the ship arrives. So Overend Gurney buys your bill for 97 cents on the dollar. They make 3%, you get immediate cash. Simple, boring, profitable. So by the 80s, the firm was moving £170 million a year. That's roughly $20 billion in today's money. They were so dominant that Walter Bagehot, the legendary editor of The Economist, called them these millionaire money dealers. Sorry, horrific English accent, I'm sorry. They weren't just big, guys. They were the lender of last resort before the Bank of England really took on that role. When banks needed emergency cash, they went to Overend Gurney. During the crisis of 1825, they literally saved the Bank of England itself. So Sam Gurney, who ran the firm at its peak, was called the banker's banker. Reminds me in many ways of JP Morgan towards the end of the Gilded Age as well, really before we had a lender of last resort in the Federal Reserve not going to get into pros and cons of central banking here, but this firm took on that similar role. And when Sam Gurney died in 1856, the Times wrote that he was respected throughout the world of commerce as no other merchant or banker has been since the days of the Rothschilds. That is some high praise, guys, high praise. And here is where our story takes a turn. Because after Sam died, the next generation took over. And like every third generation wealth story I've ever seen, and trust me, I saw plenty of these when I was at Goldman Sachs, they thought they were smarter than the old man. The new partners, the young guns, the new money, they looked at their boring, safe bill discounting business and decided it was not growing fast enough. Sound familiar? You want something more. And they saw all this exciting speculation happening. Railways being built everywhere, mining companies, shipping lines, international finance. And they thought, why are we making 3% on safe bills when we could make 30% financing railways in Peru? So between 1860 and 1865, Overend Gurney transformed from a conservative discount house into what we now call an investment bank / private equity firm / hedge fund. And they were financing, I'm not kidding, this is an amazing list, Greek railways, Norwegian timber companies, shipping lines to India, mining operations in Wales, railway construction in Uruguay and Peru, grain warehouses in Russia, shipbuilding companies that had never built a ship. One investment alone, the Millwall Ironworks on the Thames, they sank over £1 million into. That's $120 million in today's money in a single shipyard that was hemorrhaging cash. But here's the thing that is critical about this story. While they were making these crazy speculative bets, they still maintained their reputation as the safest, most conservative financial institution in the world. Other banks were still sending them money for safekeeping. It's like if today everyone thought they were investing in treasury bonds, but the fund was actually buying crypto, right? And not the good crypto, the bad crypto, and SPACs. The gap between perception and reality was massive, massive. Coasting off the old man's reputation, guys. How many firms have done something like this? Even in our lifetimes, and since the 70s, the 80s. I mean, I'm an 86 child, 80s, great decade. A lot of this has happened, guys. A lot of times the gap between perception and reality becomes huge and nobody even recognizes it because we look for pattern recognition. We look for the firm is secure and safe. Therefore, it's safe for me to put my capital with it. And you can coast on that for a long time. So here's where things get really spicy. So by 1865, the partners knew they were in trouble. The bad investments were piling up and they needed capital. So what did they do? They do what everyone in the history of finance wants to do. They went public. So on August 15th, 1865, just 9 months before their collapse, Overend Gurney converted from a partnership to a limited liability company and sold shares to the public. The IPO was 9 times oversubscribed. Everybody wanted a piece of the legendary corner house, and why not? And the prospectus, of course, mentioned nothing about the toxic assets, nothing about the failing railways or the shipyards that were burning through cash. It was all about the glorious history, the conservative management, the unshakable reputation. They raised £1.5 million from the public. That's $180 million in today's money. And the original partners, they walked away with their personal fortunes intact, protect by limited liability. So think about that for a second. They knew the firm was in trouble, and they converted to limited liability to protect themselves, sold shares to the public based on a reputation they knew was no longer deserved, and extracted their capital before the collapse. If this had happened today, people would go to jail. People have gone to jail for this exact thing. But in 1865, guess what, guys? Perfectly legal. The golden age of, doing the wrong thing and getting away with it. So then what happens? The crisis started, as these things often do, somewhere completely unexpected. In January 1866, a small firm called Watson, Overend Company, no relation despite the name, failed. Then a contractor named Thomas Savin, who was building railways in Wales, went under. Then Barnes Bank in Liverpool suspended payments. These were not huge firms, but people started getting nervous. And when people get nervous about banks, what do you think they do? By the way, pre-FDIC, pre-reserve protection, they pull their money out. So by May 9th, the whispers about Overend Gurney had started. They had exposure to these failed firms. How much? Nobody knew. But in banking, uncertainty is death. And on the morning of May 10th, a Thursday, the run began. Customers lined up outside the corner house, demanding their deposits. By noon, the street was packed. And by 2 p.m., they'd paid out over £1 million. By 3 p.m., the vaults were nearly empty. And that's when the partners made the walk, we'll call it the walk of shame, to the Bank of England. So picture this scene. The senior partners of the most prestigious financial institution in the world are sitting in the Bank of England, literally begging for a loan. They need £4 million or the firm dies before the close of business. The governor of the Bank of England asked to see their books. And when he sees the reality, the worthless railway bonds, the failed shipping companies, the underwater investments, he realizes something. Overend Gurney isn't facing a liquidity crisis. It's facing a solvency crisis. The assets are garbage. The firm isn't temporarily short of cash. It is broke. And guess what? He says no. So at 3:30 p.m. on May 10th, 1866, Overend Gurney and Company posted a notice on their door. We regret to announce that a severe run on the house has forced us to suspend payment. What happened next was panic. May 11th, 1866, known forever after as Black Friday. The stock exchange was chaos. People were literally fighting in the streets. Banks across London faced runs. Provincial banks started falling like dominoes. The panic spread like a virus to Paris, to Berlin, to New York. Within weeks, over 200 companies failed. Multiple banks collapsed. The London docks ground to a halt because trade finance disappeared. Railway construction stopped across the British Empire, and unemployment spiked. The Bank of England had to do something unprecedented. They suspended the Bank Charter Act, basically abandoning the gold standard temporarily, started printing money to inject liquidity into the system. They became the true lender of last resort, a role they would never relinquish again. But here's the critical thing. They let Overend Gurney die. This was revolutionary. The biggest firm was allowed to fail. The message was clear. Size does not guarantee you a bailout. If your assets are trash, you are on your own. Contrast that to 08. Occupy Wall Street, all the things that were happening. Many banks with trash assets and poor security standards, and by security standards, I guess what I want to say is risk management tactics, were bailed out and saved and protected. The Bank of England made the decision to let the firm die. So what happened after? The trials that followed were sensational. The directors were charged with conspiracy to defraud, but they were acquitted. The judge ruled that while they'd been reckless and stupid, they hadn't technically broken the law. But the human cost of this crash was enormous. One partner, Henry Gurney, lost everything and reportedly ended up as a hotel doorman. Small investors who'd bought shares at £9 watched them go to zero. Thousands of depositors lost their life savings. But the systemic changes were profound. This was the birth of modern bank regulation. It established Bank of England as the true central bank. It created the template for the too big to fail debates we still have today, and it proved that limited liability could be used as a weapon against investors. So why does this matter for us today? Why should real estate investors in 2025 care about a British bank that failed in 1866? And the answer, my friends, is because the pattern is timeless. First, when boring businesses try to become exciting businesses, run. Overend Gurney was perfect at bill discounting. They were terrible at private equity. And current banks try to stop being a boring bank and start reaching for yield, same story. When regional banks start acting like hedge funds, same story. Run. Be careful. Monitor what's going on. Second, and I said this before, reputation lag is real and it is dangerous. Overend Gurney coasted on Sam Gurney's reputation for a decade after he died. The public was investing in a ghost. How many firms today across these glorious United States and Europe and everywhere else are living off past glory while their fundamentals rot? Third, the IPO tell. When insiders suddenly want to sell to the public after generations of private ownership, it's important to ask why. The Overend Gurney IPO was essentially the partners cashing out before the collapse. WeWork, anyone? Good example. I don't know. Maybe so. Yep. Fourth, shadow banking always ends the same way, in my humble opinion. Overend Gurney was the shadow bank of its era, outside traditional regulation, taking deposits, making loans, but without oversight. Today's shadow banks, private credit funds, family offices acting like banks, crypto lending platforms, love to hammer on those, same risks, different century. Fifth, and this is critical for me to consider and for all real estate investors out there, leverage, extensive leverage, plus illiquid assets can and often does equal death. Overend Gurney was funding long-term railway projects with short-term deposits. When depositors wanted their money back, you cannot sell half a railway. Does that sound familiar to you guys? Many real estate syndicators today used short-term bridge debt to fund long-term value-add projects. And how many are promising investors liquidity while holding completely illiquid assets? And what if you got to get the money out? What happens, right? And fortunately, I think we'll see what happens. But fortunately, these are not a too big to fail situation. Most of us syndicators and sponsors out here, if we go under, it's not going to systemically tank the system. But the question on everyone's mind is, what is the banking exposure? And this has been discussed ad nauseum. I don't have an answer for you guys right now on the podcast, but what is the exposure by community banks to the office assets? What is the exposure to a lot of these kind of soon to be toxic real estate deals? It's a big question. Here is what worries me about this story. In 2023, Silicon Valley Bank died in 12 hours. Overend Gurney took about the same time. The speed of bank runs hasn't changed in 150 years. It's just gone digital. And there's a bigger parallel. Right now we're seeing, and I mentioned this briefly, but I want to hit this point again, regional banks reaching for yield in commercial real estate. Private credit funds, shadow banking, acting like banks without bank regulation. There is out there reputation lag in supposedly safe institutions and short-term funding of long-term illiquid assets happening everywhere. It is the same pattern. And I'm not saying we're headed for a crash, right? But these are things to be mindful of because they happen. And you know what I love about the story too? It didn't start with Overend Gurney. They thought they had it under control. They had just done an IPO. They thought the whole thing was manageable. It's something out there in the ecosystem, kind of far away from them, popped and then pop, and then hit the big boy, right? That's how it works. The partners of Overend Gurney thought they were geniuses. They thought the old conservative ways of CM Gurney were outdated. They thought they could transform a boring discount house into a dynamic investment powerhouse. And they destroyed a 60-year-old institution in less than 5 years. Human nature, guys, it never changes. We always look for, I've written about this, friends have written about this. We always are mindful of the shiny object syndrome. If it ain't broke, don't fix it. They had a great business model. They got fancy. They wanted to be creative and they blew it up. The Bank of England's decision to let them fail sent a message that goes and reverberates through history to today. Being systemically important doesn't mean that you are or should be systemically protected. If your assets are garbage, if your model is broken, size will not save you, or at least it didn't in 1866. Whether we've learned that lesson or forgotten it, well, like I said, look at 2008, because I would argue we have forgotten it. However, what would have happened if the Fed had allowed all these banks to completely fail? The human cost would have been much more dramatic. I don't know what the right answer is, guys. I don't know, but these things keep happening. We put safeguards in place, but there's one thing we cannot avoid. It is human nature. That's why I love behavioral finance. That's why I love to study these trends, these pieces of history that tell us so much about what has happened and what will continue to happen. Because if you tell me that somebody that has a solid reputation, unlimited capital, and is a young gun looking to make something happen and gets consumed by shiny object syndrome isn't going to happen again in our future, in our lifetime, well, I got a bridge to sell you. And the wheel turns ever onward. Hope you guys catch the Wheel of Time reference there. Fantastic book series, by the way. If any of you like fantasy, is the one. It gets a little slow in the middle, but anyways, it's amazing. The names of these stories change, the assets change, but the pattern remains. Boring businesses trying to become exciting, leverage meeting illiquidity, reputation lag, hiding reality. And when the music stops, someone is left without a chair. Just make sure it isn't you or your family portfolio or whatever you're investing in. Everybody, think well, act wisely, build something timeless. This has been another episode of the Timeless Investor Show. I'm Overend Gurney. Thank you for joining me on this journey through one of history's most important, impactful, and forgotten financial disasters. Until next time, remember, in finance as in history, the biggest disasters often come from the most respected names. Trust, but verify. Always verify.